And here is how they would all slot together. The governance, obviously, starting from the top left-hand corner, the governance is all important, and it comes from the board downwards. This is a board-directed risk management process. Other key aspects of it, obviously measuring it and managing it, being able to identify liquidity risk in all its forms and measure it and report it. That constituent or that component includes the HQLA, because one of the main ways I mitigate liquidity risk is through holding a liquid asset buffer on the balance sheet. The stress testing process to test the balance sheet resilience to different types of stress scenarios. Right now in May 2020, we're living and working through a market-wide stress scenario, which is the impact of coronavirus and the government's response to COVID-19 stress. So we've got that at the moment. I don't think any bank would have applied a stress test for pandemic scenarios, but now, of course, we have lessons learned from what we've observed this year in 2020. Funding strategy, I mentioned also, important part of the risk management framework. Intraday liquidity risk management, that's now a separate topic within liquidity risk management, and the Basel III has a separate has a distinct separate treatment of intraday liquidity risk management. We'll look at that later in this lecture. The funds transfer pricing strategy. If you look at the program for this series of lectures, we have a separate one on funds transfer pricing. So I won't say too much about that today in this lecture. We also have the reporting mechanism for liquidity to the regulator and to stakeholders, other stakeholders. And of course, we have the regulatory rules and supervision framework itself, which of course one can view as a baseline for everything we do with respect to risk management generally.